Did an interest rate catch your attention the last time you're looking online? Or maybe you've been thinking about buying a home, buying an investment property, or refinancing. However, it's very rare that the interest rate that you see online will be the one that you get from the lender. That's what we're checking out today. Let's go. Hi everyone, I'm Bryn with Hearthstone Real Estate here in Eugene, Oregon. On this channel, I talk all about the Eugene area and give you some real estate tips along the way. There are many factors that determine the interest rate that any of us receive. Here's a great rundown for you or anyone you know planning on getting a mortgage or refinancing. How do interest rates work? Let's cover the basics first. Interest rates for mortgages can fluctuate on a daily basis, going up or down. Freddie Mac posts the average U.S. rates for popular mortgages every Thursday after surveying lenders across the country. These are the rates that you'll see or hear about in news media reports, especially when the 30-year fixed rate hits a record low. Lenders want your business. Mortgage lenders promote their own interest rates on their websites. However, what you see isn't necessarily the one you'll get. Usually these promo rates are really an average of rates that they offer, and you'll need to read the fine print to find out any restrictions or requirements. Most lenders offer several mortgage products, some better, less costly than others. What impacts your rate? Here's a breakdown of the variables a lender will consider. First up, credit score. Your score and credit history play a huge role in the rate that you'll be offered. It lets lenders know if you're a good risk or not as a borrower. A high score of 740 or more means you'll get a lower rate since you've proved you've handled credit responsibly in the past. Even if your score is considered good, which would be anything above 700, you'll still have a higher interest rate if it's not 740 or above. Also, the lower your credit score, the higher the rate since you're viewed less creditworthy. Number 2, down payment. There are different rates depending on how much you put down. The larger your down payment, the lower interest rate because the loan is deemed less risky to the lender. A bank views your loan more positively if there's more equity in your home. To qualify for some of the best rates, you need to be able to put at least 20% down. If you put 25% down, you get an even lower rate. And if you have less than 20% down, your interest rate will be slightly higher, and you might also have to add private mortgage insurance or PMI to your monthly mortgage payment. Number 3, the type of property. Did you know that condos have slightly higher interest rates than single-family detached homes? A condo loan could be 1/8 to 3/8 higher since lenders view condos as more risky since they'll be dealing with other condo owners and your homeowners association as well. Number 4, different products. The interest rates also depend on the mortgage product. There are jumbo loans, FHA loans, VA loans, adjustable rate loans, and conventional loans, all of which have different rates, fees, and requirements. Number 5, loan term. Usually loans with a shorter term have lower rates. A 15-year fixed rate loan will be lower than a 30-year fixed loan. ARMs or adjustable rate mortgages, which have become popular because of the improved regulations, will have an even lower interest rate. Number 6, loan size. Larger loans usually have higher interest rates. If you need to borrow more, the loan is considerably riskier. Jumbo loans usually also require larger down payments. If you have one of the contributing factors that we've discussed, your rate will be much higher than what is advertised out in the world, so just be prepared. And here's a bonus secret, it's the APR. Want to know what the easiest way to compare lenders is? It's called the APR, which stands for annual percentage rate. It includes any fees incurred for the cost of obtaining the loan. Closing costs, any points, and an origination fee are used to come up with the APR, along with the actual mortgage rate you're offered. This APR number reflects the true cost of the loan. It will be a higher rate than the interest rate alone. Here's where you really need to look at all of the details and the fine print to see what each lender is actually offering so that you can compare apples to apples. Here's an example. A lender may offer a low interest rate but charge 2 points, or the lender may offer you a higher interest rate with no points. How do you know which one is best or the cheapest money to borrow? Just look at the APR. It might even be the offer with the higher interest rate. It has the lower APR since the lender is not charging you for any points. I hope you found this information helpful. I'd love to hear from you. You can call, text, or leave a comment down below. I work hard to stay connected. Don't forget to hit that subscribe button and join me for my next video. Thanks so much for watching.